Hello, everyone, and welcome to Heritage's 2023 Market Outlook. I'm Bob Weisse, Chief Investment Officer at Heritage Financial Services, and I'm here today with a special guest, Brad Long. Brad is the Deputy Chief Investment Officer at Fiducient Advisors. Fiducient is an investment consulting firm based out of Chicago that Heritage has worked with since 2020, and we view them as an extension of our investment team. So it's an honor to have Brad with us today. Brad will be walking through some slides reviewing market themes and capital market assumptions. And as we go through, we'll be taking questions. So please use the Q&A feature on the Zoom app to submit questions as we go. There were some questions submitted in advance, and we'll also address those as we move along. So Brad, before we get started, would you mind just giving a quick introduction to yourself and talk about Fiducient?
Sure. So hello, everyone. I'm Brad Long. As Bob mentioned, I'm a partner and deputy chief investment officer at Fiducient Advisors. So as Bob mentioned, we help work to kind of augment and supplement a lot of the work that Heritage does internally. Fiducient Advisors is a $230 billion investment consultancy, mostly working with institutional clients. So think of endowments, foundations, retirement plans, where we help build asset allocation, investment selection, and help draw portfolios. And that's where we kind of bring unique insights and augment a lot of the work in financial planning and unique circumstances that Heritage brings to you all, and we bring a unique and alternative perspective.
Excellent. Thanks, Brad. So let's jump in. Can you pull up the slides?
All right. So as we begin each calendar year, we do take a step back and look at, hey, what are the opportunities in markets today? What are the risks in markets? And oftentimes we'll boil down a lot of information out there into kind of key and primary themes that are going to be driving the markets in the year to come. Now, in this year, we've really boiled them down to the three you can see on the screen here. I do want to note, just kind of out of the gate, as we know, markets don't really know that, you know, the calendar starts in January and ends in December. So some of these themes kind of transcend 2023, but we do think some of them are going to be quite acute in the coming year. So the three things that we really think are going to be driving markets, and really what is driving our year-over-year changes in allocations and opportunities, are the three following themes. So the first is persistent volatility. The idea that, you know, kind of the recent period in history, call it almost the last 15 years since the global financial crisis, has actually been a unique period, and we're exiting back into more normal. But normal is going to be meaning more volatility, and we'll talk about what that means in just a moment. The second is moderating inflation. I would say the key word in there is moderating. It's not extinguishing inflation. So we do think inflation is moving in the right direction, which is slowing, but there's going to be fits and starts, and we don't think we're going to per se solve it in 2023, but that's not necessarily what we need, and we'll tell you more about that in just a moment. And then finally is a bear market bottom. Now, this is a comment more towards 2023, but, you know, those of you that have worked with Heritage for a long time, or you know, kind of talk about, you know, what we do in markets, this is not a market timing idea. This is not to say what's today, January 10th, that, you know, markets are going to bottom today and we'll rally from here. It's the idea that 2023 in aggregate is going to be a better year to add risk to portfolios and prepare for what we think is, you know, a bear market bottom, where we're closer to the end than we are to the beginning. So why don't we unpack these a little bit more, kind of starting with probably the most pervasive and longer term theme, which is this idea of persistent volatility. So coming into 2022, we were really ending a period of an extraordinary economic period. Honestly, since the GFC, which, you know, Ben Bernanke took a hold of the Federal Reserve in February of 2006, and then quickly stepped into the global financial crisis in 2007, the Federal Reserve and central bank officials have been on kind of an extraordinary march of extremely low interest rates, the benefit of low inflation, extremely accommodative monetary and fiscal policy, and that has created kind of the environment of which we're in. In fact, since February of 2006 to actually March of 2022, which is just before we started increasing interest rates, the average federal funds rate over that period was just 1.1%. Whereas if you went prior to 2006, all the way back to 1955, the average federal funds rate was well over 5%. So we've been in this pretty unique period. And this graph on the left here has come to kind of exemplify this idea of extraordinary fiscal stimulus and the pretty quick unwind as a result. So the dark blue line here is actually the cumulative market value of negative yielding debt around the globe. And if you can't see the left bar chart here, this is in trillions, right? So this was a massive issue and really emblematic of this idea of punitively low interest rates, peaking at above 18 trillion in debt. Now, since then, and really materially in 2022, you can see kind of this cascading waterfall down here where we're exiting this idea of zero bound interest rates, extraordinary monetary accommodation and fiscal accommodation. And this period of time has also created a lot of pretty interesting market events, right? Whether those be, kind of meme stocks or those characterized with probably poor to weak fundamentals, but yet the price of those securities go up by, hundreds or thousands of percents in some instances. Cryptocurrencies, this isn't the damnation on cryptocurrencies, but the idea that a cryptocurrency exists on a public ledger and is completely independent of markets from stocks and bonds. I think the air was let out of that balloon in 2022, and that, when the price of a security is really dictated by the willingness of someone else to pay for it, it's going to have a relationship to the market, just like stocks do. And we certainly saw that in 2022, and then some of these more unique aspects of extraordinarily low interest rates, like negative mortgages, the idea that a bank would pay you to lend money to you to purchase an asset. You don't have to step back too far to realize that's a pretty unique environment. And as we unwind some of that, we come back to normal. And so what is normal? Normal for us is likely going to be a period of, where stocks may have higher volatility, bonds may have higher volatility, real assets and kind of the intermingling of all three of those might have higher volatility, but that doesn't necessarily mean a bad thing. I mean, the necessary evil to opportunity is volatility. Volatility creates opportunity. And so the punchline for us, as we think about, and we'll talk about in a little bit, the net effect of kind of unwinding some of the zero bound interest rates means we're moving into a period where asset allocation matters even more than it has in the past. That building resilient portfolios is likely going to be paying more dividends, if you will, than it has in the past. And that we should operate with humility, that there's, with greater volatility means kind of mistakes where errors are made can be punished more, right? So don't lean too far in to opportunities or lean too far away from risk that might create some unique circumstances. So really building that into portfolios. And we think that this isn't just a 2023 theme, this is far more of a secular theme going forward. The next is moderating inflation. So this is one that, if 2022 could be characterized by anything, it's likely going to be characterized by inflation and what that meant for the Fed, and the Fed, frankly, trying to play catch up in moderating inflation. Now, the bad news on inflation is that we're not there yet. Even our November print of inflation, while better, is still materially higher than what the Fed or the average consumer would like to see. But the key point here, as I mentioned before, is moderating inflation, not extinguishing inflation. We don't have to solve inflation in 2023 for the markets to look beyond inflation and start to build a bottom here. Instead, we just need to see the path, a reliable path towards something like that. And we're starting to see that in inflation data. So even as of November, which is where this data is quoted from, as we look at kind of the breakdown on month over month, not year over year prices, core CPI rose by just 0.2%. So that's CPI excluding energy and food. So it's a pretty modest increase. Now, the bugaboo with inflation has really been around shelter. So shelter, as calculated by CPI, it actually uses kind of a funky thing called owner's equivalent rent, because not everyone in America owns a home. Actually, most Americans rent a home. And so they can't just look at home prices. They have to look at some type of equivalent. Well, even though home prices have been falling on the backs of higher interest rates, mortgage rates, the CPI calculation has been showing the cost of shelter increasing. So if we were to hold food and energy, food and energy, and actually just hold shelter flat over the month, we could really start to see the turn in some of these prices where, actually core CPI, food, energy, and holding shelter flat would be down 0.1% month over month. Now, again, that doesn't mean we've solved inflation, we're through the woods. Frankly, we think it's going to be somewhat of a bumpy road on the way towards the Fed's target of 2%, but we're moving in the right direction. And that is an important component for future success and ultimately markets bottoming. Bob, I know we did receive a couple of questions on inflation and kind of impacts of different policies on inflation. Did you want to pull any of those up now before we, start running through?
We received a question asking about the Inflation Reduction Act and its impact on markets. So now's probably a good time to hit it. So what are your thoughts on the Inflation Reduction Act?
Yeah, so it's a great question. For those not familiar, the Inflation Reduction Act was passed earlier, I think it was early fall, if I remember correctly, really designed to address kind of some of the acute concerns around inflation and slowing inflation. Obviously, it's a big political issue to be a sitting Congress, a sitting executive branch, and having an electorate that's upset about high gas prices, et cetera. So it really had a number of underlying components. The first, I would kind of wrap the two pieces I'd wrap into one, which is really around kind of tax and tax enforcement. So a minimum corporate tax of 15% and actually an allotment for the IRS for greater enforcement over the next 10 years. So for those that actually owe taxes, that they pay taxes. Neither of those have, I would say, kind of material or observable, especially in the short term, impacts on kind of the rate of inflation. So, actually making people pay the taxes that they were going to pay, doesn't have a material influence on inflation. Now, as we start to get into the other components, the next two actually both relate to an important part of inflation, which is healthcare inflation. But one is probably more of a Band-Aid and less of a solve, and the other is seeking to be a solve, but it's got a long way to go. So the Affordable Care Act subsidy extension, which was part of IRA, that actually reduced the premiums paid for participants in that program. That feels like a reduction or at least a limitation of inflation because it's being subsidized, extended until 2025, but it doesn't address kind of fundamental long-term healthcare costs. So it's more of a fix today, but borrowing from the future kind of thing. Whereas prescription drug reform, which is also part of that, allows Medicare to negotiate on behalf of participants to seek lower drug prices. That is something that a part of healthcare inflation that does need to be addressed. The price of medication and medical services in the United States is materially higher than other countries, and so it's a step kind of in the right direction. The final one, which is probably knocking on the door of the most inflationary component over the next multiple decades, is the investment in energy and clean energy. The transition from brown to green energy over the next 2 or more decades will probably be the most expensive capital investment that the United States has seen kind of since the industrial age, even adjusted for inflation over time. It will be in the trillions of dollars. Offering subsidies and dollars to help kind of start that transition or continue that transition rather, is definitely helping long-term inflation. The only thing here is maybe the size that it was done in, that it's probably not going to be all that meaningful today, right? So as we experience inflation on a day-to-day basis, as opposed to on a rolling 10-year basis. So it's got the right idea, but maybe the wrong magnitude. And so I don't know if it will be felt today. So IRA probably has a lot of underlying components that are knocking on the right doors, but I don't know as investors that will really feel that in a real material way. So this idea where we're talking about kind of moderating inflation, right? So IRA is kind of trying to knock on that door. We do see even outside of IRA some moderating inflation figures, which is healthy for markets to eventually bottom, which gets us to our third theme, which is this idea of kind of a bear market bottom. And again, we're not trying to be overly prescriptive on this is happening January 10th or April 1st or May 15th. That's not the idea. The idea is twofold, that 2023 is a better year to add risk, and without kind of the idea of perfect prediction. We want to have better preparation because we know markets will eventually rebound. We just don't know precisely when. So as we think about the pattern of market pullbacks, it usually happens something like this. It's not a perfect law of physics, so it doesn't always happen this way, but it looks a little something like this. If you look at the price of the S&P 500, you can actually break that into two different components. The first is the earnings per share. So a business sells a good, they have revenue, they pay expenses, they ultimately have earnings. Those aggregated earnings are the economic value from those companies. And so that's the earnings per share. So an investor would then say, okay, I see those earnings and I'm willing to pay I'm willing to pay X multiple for them. The idea of that multiple says, kind of with investor sentiment, how much you're willing to pay for earnings, and multiple times earnings equals price. So that gets us to a headline figure. Now, multiples are something that can change on a dime, right? They're based almost more on consumer sentiment they are on anything else. And so they're one of the first things to react in bear markets. And this graphic actually is a good pictorial of this. So the pretty steady and consistent blue line, and this is just calendar year 2022, is earnings. And this closes as of Q3 2022, because we don't have earnings data for Q4 yet. Those are going to be released over Q1. So that's just starting now. You can call it earnings are largely flat. Technically, they're slightly up, but we'll talk about that more in a moment. The dark blue line is actually the price performance of the S&P. The green is the difference. The green is multiples. So as the Fed has been raising interest rates, investors are saying, I'm far less willing to pay higher prices for this level of earnings. So I'm going to pull back. As they do so, prices fall. So that has been the kind of primary component, and multiples are usually the first things to move. So the benefit as we think about trying to find a market bottom is we want to see multiples having already come down. Now they could go further, they could rebound, right? We don't have precise information here, but we're trying to kind of use this as a general guide. The next kind of shoe to drop as we think about the pattern of multiples go first based on sentiment, then we end up talking about the Fed. So if the Fed is active, and Lord knows they were active in 2022, then often the Fed will pause or pivot. So what do we mean by that? If they're increasing interest rates, they'll stop, which would be a pause. Or if they pivot, means they actually go from increasing to decreasing interest rates. Actually, throughout history, there's never been a period of time where if the Fed has been an active participant during a bear market, meaning they've been increasing interest rates, that markets have actually bottomed while the Fed has been increasing interest rates. Now, that's not a law of physics. It could certainly happen this time, but it's a pretty good indicator that, of the old adage, don't fight the Fed, right? It's difficult for markets to find their final footing when the Fed is kind of actively working against them. So that's kind of the second piece here. The third then comes earnings. So earnings, by definition, are lagged, right? They tend to be looking in the rearview mirror. They're reported on a quarterly basis, and the effect of the economy is lagged in earnings. So inflation influences wages, wages influence earnings, earnings then kind of trickle downwards, right? So it's not an immediate effect. Now, we do start to see kind of the recent drop in just the very end of Q3, but to be honest, the year-over-year impact here on earnings, largely being flat, has mostly come from the benefit of the energy sector. The energy sector in 2022, earnings increased almost 140%, largely on the back of Russia invading Ukraine in February of 2022. As oil prices increased, revenues increased, and earnings increased. So if we actually pull out energy and look at 2022 earnings are down about 5%. So what does that mean in kind of context of history as we're trying to, again, start to read tea leaves here and think, is 2023 a better year to invest or not? Well, since the late 90s, looking at material pullbacks in markets, the average, and again, markets don't, reality doesn't live in averages, but just to give context, the average is earnings from peak to trough would come down about 13%. Now, there is a little bit of nuance in there. In periods of time where you have kind of a deeper protracted recessions, earnings actually fell 26%. If you get more modest pullbacks or modest recessions, earnings only fell 3%. So if we just say, hey, we're at 5, and 5 obviously lives between -3 and 26, where are we? Our general view is that if a recession happens, and we'll talk about that in a moment. And Bob, I've heard you characterize 2022 as the year of inflation and 2023 is the year of recession. If we do experience a recession in 2023, our view would be it would not be kind of the exogenous, existential, big recession like the global financial crisis of 2007, 2008. Like if anyone's seen the recent Netflix series on, looking at Ponzi schemes, some of the footage is watching that, that was almost PTSD thinking back to that period of time. Today is not likely to be that. So, the reality is we're probably closer to our kind of full earnings recession than we are, to this kind of 26 figure. But Bob, I know you had some kind of questions and thoughts, and maybe even we had some questions come in on kind of recession or non-recession. So why don't we pause there and see if we've got any questions? And then if not, we can just jump straight into kind of the idea around recession in 2023.
Yeah, I think what's really pointing towards a recession are the leading economic indicators. And I believe the next slide has that. So why don't we just keep this topic going with recession red herring.
Recessions, obviously, given our previous slide and kind of the context of what that could mean to earnings and how we find kind of market bottoms, if you will, they matter, right? The economy and markets are related. Now, it's important to remember they are related, but they're cousins, they're not twins. So as we think about a recession and the likelihood of a recession in 2023, yes, LEI, leading economic indicators, as Bob mentioned, have been falling. There's often cited kind of the 9 months straight of falling leading economic indicators most often lead to recession. You can use the inversion of the yield curve or kind of other, some mathematical based, some more farmer's almanac type indicators to say, hey, is a recession coming in 2023? The answer is we and no one else precisely knows. But let's also talk about just kind of what recessions are. Recessions are fairly normal, right? They happen every 6.5 years. They are not abnormal to the economy. The economy doesn't grow linearly. Usually it gets a little ahead of itself and then it falls back and then it goes into another period of growth and gets ahead of itself and falls back. And so, markets exhibit that similar pattern as does the economy. So again, if we look to 2023 in a recession or not, probably the more important question is it this kind of protracted, exogenous, deep, long recession like we saw in the GFC, or could it be more a classically cyclically led standard recession that's not led by these big imbalances like Bear Stearns and Lehman Brothers and AIG and kind of does the financial system exist or housing prices falling in such a material way? So that would be the first question we need to answer, and we largely just answer that. We think it would be more the former, right? The more benign kind of classically cyclically led recession rather than this, more exogenous event. The second thing, though, to remember with recessions is that, again, markets and economies are cousins, not twins. And so if we try to time a recession, comes to the title of the slide, it's kind of the recession red herring. We're actually timing the wrong thing. So if we look back to 1950, the green line here on the screen is actually industrial production. So a growing economy or a falling economy. And the blue line here is markets. So it's the S&P rising or falling. Clearly they are related to one another, but they're not twins. They're not overlapping here. So markets tend to peak about 7 months before the economy peaks, and markets tend to bottom 3 months before the economy bottoms. And so as we think about how we position portfolios in 2023, waiting for the all clear horn on recession and earnings and whatever else you'd want to throw in there, a ground war in Europe or Xi's third term in China, right? There are a lot of these things that sit out there. Waiting for the all clear horn likely not only means you likely miss the bottom, but it also means that prices may have moved even more materially. So as we think about 2023, again, without kind of the perfect power of prediction, we're using preparation, and that's where we're preparing portfolios for upward movements in markets, preparing for opportunities for markets to rise, and using kind of that framework that we said, hey, we think we're far closer to the end than we are to the beginning, which leads us to 2023 allocations.
That's great. So As we transition from the themes, thanks for reviewing those, Brad, to 2023 capital market assumptions. I'd like to just point out for our audience at Heritage, we use capital market assumptions that are based on 10-year return projections. And with those return forecasts, we build portfolios. So those are the data inputs. And it's important to know we're looking at 10 years for returns in stocks, 10 years for returns in bonds, not 1 year. So while this is called the 2023 market outlook, we don't build portfolios year to year trying to project what asset classes are going to do each year. And maybe, Brad, you at Fiducient has been doing capital market assumptions, I believe, since 1992. And
That's right.
Can you talk a little bit, just high level, about the process and why you do 10-year capital market assumptions?
Yeah, it's a great question. So the process behind it, so we have a dedicated team, it's called our capital markets research team, that's responsible for these inputs. So the inputs we're about to go through are, hey, what are US bonds going to perform in the next 10 years, or the S&P over the next 10 years? Then those inputs then go into the foundation to build portfolio allocations and updates and position portfolios for what we think is kind of the best portfolio over the long term. Now, 10 years is an imprecise figure. You could use 7, you could use 12, but the reason you use 10 and not 2 or 1 or 3 is that trying to predict markets in the short term is very ineffective, especially using valuation. You know, today, prices are going to move based on all sorts of factors, probably mostly headline, and there's a lot of noise and very little signal, right? It's hard to actually stick to that and make money on it. As opposed to over the long term, there's quite a bit of efficacy in looking at valuations, current yields within fixed income to tell you, not just on a relative basis, does this outperform that, but also the magnitude. So if, you know, bonds are going to perform 3, 4, 5, 6% over the next 10 years. And so using that long-term or longer-term view allows us to have a frame that has a fairly high probability of success. Moreover, it's not so long that we're ignoring the current, right? You could just say, well, let's just be 50 years. 10 years is enough that if you get material dislocations in the market, say like in 2022 or 2020 or the GFC, that you are going to have enough that you're going to materially update, right? So it's not ignoring the current, but it's also not getting caught in the noise of the current. And there's a good balance between there.
Thank you. So let's jump in and look at the numbers.
So as Bob mentioned, we look at kind of all forward-looking returns on this 10-year basis. And rarely would you hear from us or anyone. Fixed income is the really exciting part of this conversation, but guess what? Fixed income is the exciting part of this conversation. If we rewind the clock to this time last year in 2022, we were talking about fixed income returns that were pretty darn unattractive. Even with very, very low rates of inflation, you were talking about this flat to negative real returns, so returns above that of inflation. So let's just use the top line, US bonds. The 10-year forward-looking return as of 2022 was 1.7%. Not all that interesting. Now, through unprecedented amount of price volatility and pressure and the Fed moving faster and at a hotter clip than we've seen, you know, really since the late 1970s and early 80s when Paul Volcker kind of broke the back of inflation. You know, it's been a bumpy road to get here, but now that we're here and we look at fixed income yields, which are the primary predictor for future returns, they are far more attractive today than they have been in recent history. And so just using that US bonds example, 1.7% versus 5%. You know, it's almost a 200% increase in return and outlook, and that makes fixed income kind of far more attractive than it once was. And so as we think about year-over-year allocations, we're much more interested in fixed income today, full stop, but also with recharged yields. We think fixed income can begin to play the role it has in past cycles, where if markets are volatile in 2023, or the idea of persistent volatility, which we were talking about before, starts to play out, bonds can become more of a diversifier and you're being paid to wait. Whereas historically, or at least in 2022 rather, that was not necessarily the case because of extraordinarily low yields. So as you kind of tick down the screen here, you look at US bonds, TIPS, dynamic bonds, high yield, global bonds, muni bonds. The change in 2022 to 2023 is very material and frankly beneficial for us as allocators going forward. Now, as we fast forward into equity, which is usually the really sexy part of the ledger, still interesting here, but you don't see a 3x increase in year-over-year returns. So if we start it with US equity, right? US equities started last year at very full valuations, and then throughout the year came down to, call it average. As we look at international valuations, they started at average valuations and then came down to below average valuations. So when you look at the magnitude of the increase year over year, but also just the difference in outlook, a 6-7 versus, call it almost 9 or over 10, that creates substantial opportunity here outside of the United States. And I know many people are probably thinking, hey, the US has outperformed international for a decade now. Like, why would we believe it now? I think if you take that question at 30,000 feet, I would just say, 96% of the global population lives outside of the borders between New York and California. 84% of global GDP lives outside of the United States, and 72% of the stocks that are just listed on exchange are outside of the United States. So to that end, even over the last decade, where the United States has hand and fist outperformed international markets, 64% of the best 100 performing stocks on average over the last 10 years have been outside of the United States. But more acutely today, and where valuations are, the current strength of the dollar and the unwind of that based on Fed policy and the opportunities that exist outside of the United States make ex-US very attractive. Even Q4, which is just a very short period in a 10-year window, right? It's just one quarter. But we saw an unwind a little bit, a retreat in the US dollar. We saw some normalization and slowing in Fed policy. EFI, the Developed International Index, which is where there's an active ground war in Europe, was up over 17%, whereas in the fourth quarter, the S&P was up 7.5%, right? So that type of rebound is something that we can benefit from as global-oriented investors, as opposed to, kind of head in the sand, just S&P investors. So I know it's been a long run for the S&P, but for a whole host of reasons, we think, global portfolios are attractive today. And then expanding into, sorry, go ahead.
Maybe just pause in 1 second, going back to the previous slide. A question came in, and let's address it now, asking about our perception of geopolitical risk and its effect on our outlook. So these numbers are great, but there's more risk overseas, right? So how do you think about that?
It's a great question. So these numbers account for the changes in geopolitical risk. So if you were to simply just run kind of the blind math, if you will, and say, just purely based on valuation, what's my forward-looking return on international and emerging? It would actually be higher than what we see here. We've adjusted these for, all sorts of geopolitical risks, and that list is fairly long, and for good reason, right? It could be expansion of a ground war in Europe, the first since we've seen since World War II. Could be sovereignty of Taiwan, Xi's third term, COVID zero policies, right? There's energy uncertainty, right? Like you could put yourself in a tailspin, trying to list out all the potential concerns and geopolitical risks, to list abroad. Nonetheless, to some degrees, there are some new geopolitical risks. To some degree, it's the same old geopolitical risks, right? I would say the new tailwind is the version of kind of deglobalization, right? We're not going to uncouple economies, but we've been in an era since the 1980s of, kind of single lowest cost trade partners, and we're moving away from that direction. You can see it through semiconductors and others. But the idea that a sovereign is flexing muscles here, or there's energy uncertainty there, or that is not new, and markets have cycled in and out of that, including the 2000 to 2010 period in which emerging markets more than doubled up the S&P 500. So geopolitical risks, we are aware of them. We have accounted for them here. But I would also say, risk is not new to investing. It just might feel a little bit more in our face today.
Thank you.
So great question. If you have them, just keep them coming in. And then just to round out here on forward-looking assumptions, so real assets and alternatives. As we mentioned, real assets with the idea of moderating but not extinguishing inflation will continue to play an important role in portfolios to help kind of moderate volatility along that path. And then alternatives where they're applicable, right? Not all clients in all places own alternatives, but whether those be interval funds, liquid alternatives, or traditional alternatives in a period of higher volatility and more persistent volatility, which we mentioned up front, asset classes that can take advantage of greater flexibility for utilizing volatility in their favor, and B, not just being beholden to the full brunt and volatility of the market, but being able to use tools to hedge that volatility can be useful tools, but not for every client and every situation. But in certain instances, those can be powerful tools. So, for these alternatives, we think there's still great opportunity here going forward in the next 10 years.
Thank you, Brad. And one thing for our clients on the line, in late 2022, we did some rebalancing in client portfolios, and it was based off of this research. And the general theme is bonds are more attractive, yields have gone up. And when we've looked back at capital market assumptions, to give Fiducient some kudos, they've nailed it with their forecast in bonds, because the process is very solid, and the yield is what your return is going to be. So when you see those returns go up 3%, that's something that we can count on. So we went into 2022 underweight bonds with a low allocation to bonds. Yields went up. So now we have adjusted portfolios and increased that allocation to bonds. And we've also done it through introducing treasury bonds to the portfolio. So treasury bonds, now that they come with more attractive yields, they also, we think, would hold up well if we had a recession. So we don't know what 2023 will hold as far as the stock market and the economy, but if it does get bumpy, we think treasuries will be a good place to be. So that's an allocation that we built up. And we did that by taking profits in some of the areas that performed the best for our clients in 2022. And one of those actually that ties into another question that just came in: what are dynamic bonds? Brad, I'll let you take that. So what are dynamic bonds?
So typical bond portfolios will kind of simply purchase a bond at a maturity, oftentimes hold it till maturity, and utilize the current yield associated with it to generate return. Dynamic bonds, almost in the name, it's kind of more of a marketing name than it is an asset class, are trying to be more dynamic within that allocation. So they are they adjust positioning within their portfolios. They use tools outside of just traditional bond ownership. So they use things like futures or forwards to adjust their positioning. So the net effect is they're less beholden to the direction in interest rates, which bonds are very subjective to, and you can see that in 2022 bond returns. Dynamic bonds held up. Dynamic bonds isn't an asset class, so you can't say that as a blanket statement, but many more dynamic managers held in much better in 2022 than did your traditional bond portfolios. And it's the utilization of kind of that more flexible approach. So that's dynamic bond.
Thank you. One of the dynamic bond managers that we worked with did relatively well in 2022 compared to the bond market by using futures and being very short term. And as interest rates went up, that fund held up quite well. We sold that fund and used the profits to put more into core bonds. So now we're taking more interest rate risk, and you also get lower net expense ratios. So now that the bond market has improved, we have less money in dynamic bonds and more money in treasuries and core bonds. We have one about ESG. So ESG, it's an acronym for environmental, social, and governance investing. That's something it's a personalized discussion with the client. ESG means different things to different people. We do have solutions at Heritage, so I'd encourage you, if you are interested in learning more about investing with an ESG approach, to talk to your wealth management team. So, well, thank you everyone for joining today. We appreciate your joining us this afternoon. And Brad, thank you for your time in reviewing these slides. I hope our clients found it very helpful. And if you're not a client and interested in learning more about Heritage, you can reach out to us a number of ways. Let's talk at heritagefinancial.net or call us. Part of our introductory process includes a review of your current portfolio, where We'll look at your portfolio and give you a second opinion. And of course, we'll go through any personal questions that you have. So with that, we'll wrap up today's webinar. Thank you, everyone.
Thanks, Bob.